What's up, guys? It's Mr. Fit to Flourish, and today I wanted to talk about how to react to key levels and how to play key levels. And the first thing I wanted to talk about when it comes to key levels would be trends. So you need to understand where the trend is and how to play those key levels based on the trend. So overall, characteristics of some strong trends we talked about in another video, but it would be big gap openings, trading in one direction for more than 2 hours on intraday during day trades, having few counter trend trade opportunities, so very little pullbacks, and then bars with no tails in either direction, which shows a lot of strength in either buying or selling based on where the trend is, and then no significant trend channel line overshoots. These are characteristics of strong trends. You need to keep this in mind. So what happened yesterday? So as of the time of this recording, it's September 20th. Yesterday we had a huge gap opening, September 19th, after the Fed, after FOMC, after the Fed had cut rates by 50 basis points. This was the first cut in over a year, okay? And what did that cause? It looked like the market was going to sell off early on. If you look at Tesla was looking like it was selling off after Jerome Powell's speech. And everybody was like, oh, the market's coming down. The market's coming down. Well, I got news for you. The market's in an uptrend, and rate cuts means that people are going to have more free money, as it's going to be cheaper to borrow money. So more free money means more money going into the markets and risk on assets like cryptocurrencies. Look for crypto to potentially continue to rip. We're holding the $63,000 level right now on cryptocurrency. So look at that. But in terms of reacting to these key levels and big news, you're not going to miss the next one after this. I promise. Okay. So if you day trade, and I personally day trade options, there's a lot of different strategies you can employ. This is my strategy. So I have these key levels marked, and at the end of the video, I'll show you how to mark key levels because there's already a video on that. But I look at my key levels, I see where we are. It looked like we gapped up above the key level. We tested it to the downside, and it looked like we broke. My key level here is the dotted line, 233.48. On the first 5-minute candle, we broke below, but then we wicked up. We had a massive bottom side wick and created what's called a micro double bottom. Micro double bottom is a close and open next to each other, or an open. Well, it'd be a open, close and open. So close and open next to each other, and this was a bullish engulfing micro double bottom. What does that mean? That means that the green bar was bigger than the red bar that formed, which shows that there's a lot more buying pressure than there is selling pressure, and basically holding this key level. So at the time that we hold the key level, so there's only two things you can really do when it comes to key levels, okay? And this is, I'm going to keep it as simple as possible. I know some people know IZT, SMC, ABC strategies, but at the end of the day, you need to accept the risk of the trade that you're putting on, because it could go the opposite way. All ICT strategies don't work. All SMC strategies don't work, okay? You need to back test on your own, see what works for you, and what you're trying to do, because it might work for someone who's trying to scalp, but then it might not work for someone who's trying to swing, and they'll be like, oh, it doesn't work. This person says, oh, it works. So it depends on what you're trying to do and what you're looking to get out of the trade. Anyways, key level here, all you could do is test the key level to the downside and hold, okay, or test the key level to the upside and reject. So either you bounce, we bounce, or and that's if you open up above, or we start below and we reject. It's really the only two things you could do. I mean, you could say, okay, well, we test the key level to the downside and we break through. Okay, that's just a breakthrough. But what we're looking for is, okay, since we're above the key level, we want to see, do we hold, do we tap it, and then rip to the upside? And if we're below, do we tap it and reject? That's really the two things that you're looking for when you're looking at key levels. Are we above it? And if so, do we hold? Are we below it? And if so, do we reject? That's the two questions you need to be asking. Keep it simple. Okay. You're gonna be like, oh, well, what if it does this? Well, what if it does that? Well, that's why you're not making money. Stop, stop overthinking things. Jeez Louise. Just kidding. Anyways, so we formed a micro double bottom, bullish engulfing bar. Entry, a good entry here would be after this bullish bar. What would be my stop? Well, just keep your stop at the wick, because we know that we put in a low. If we go past that wick, we're probably cooked. We're probably cooked, okay? So that's really, that's it. That's what is, that's all that there is to, okay, let's get in on a key level break. Wait for that test to the downside, okay? And we bounce. There's other factors in this, as you can see, we had a 920 crossover to the upside. We had a lot of bullish momentum on the volume R side. So there's confluence that you need to be looking for sure. Look for confluence, which means you need evidence that the trade will go in the direction that you are trading. Our MAs are really bullish here. The 9, which is my pink line, is going up above the 20. The 920 crossover is huge in terms of significant moves. We have the 20 above the 50, above the 100, so everything's in order, okay? And we're ripping, and we're holding that 9 MA. But when you're looking at key levels, ask the question, okay, we opened up above, now we're going to test it. Micro double bottom, bullish engulfing bar, building momentum, 920 crossover to the upside. We're holding this support level, this key level, and we're ripping. So take the risk. And if you don't want to take the risk, don't put on the trade. Okay? Take the risk, or don't put on the trade. Okay. Another example of something I was talking about in terms of rejecting on these key levels. Look at this. So this level here at 240.45 on Friday the 20th was acting as a resistance level. So what happened? We had a 920 crossover to the downside, failed to hold this level. Now, what did I say? If we're below the key level, look for signs of rejection. So we're below. Now we're putting in topside wicks. What other confluence do we have? Well, we have the 9 MA below the 20, which is very bearish. But look, we got a rejection. We got topside wicks forming, bear bars forming, and we continue to the downside. And then we caught on the 200 MA here on Tesla, and guess what we did again? We tested that upside. And again, once you get a nice bear bar, looks like we're trying to reject here. What do? You get a nice bear bar, so we enter after trend bars. So we're not going to enter after this doji, we're going to enter after this trend bar. So on this rejection, take the risk. Enter one tick after this bar forms. So not while the bar is forming, but after the bar forms, you enter on the next bar. And you set your stop to the top wick. Because if we go past that, you know you were wrong. But what's the risk to reward? The risk to reward is absolutely ridiculous here. Because on a reject of this key level, we can target the low of day. Especially after a quick move to the upside like this, there's a lot of order imbalance, which just means that for beginners, it just means that we moved up too quick. We need to balance out price action. We moved up way too fast, so we're going to probably come down pretty fast. So if you guys are familiar with risk to reward, we talked about this in another video, but we take a short position, we buy puts, or take a short position, set our stop to that top of the wick, and then our target, you could target the low of day. Or we know that we bounce off of the 200 MA, okay? Or you could just use the order block. So these lows here. But anyways, I like to be a little bit conservative, so I would probably target the order block. So that wick is the last move down, okay? The last bar that went down. So if I target that, my risk to reward ratio is 4.11. So that means that for every dollar that I could lose, I could gain $4. That's insane. That risk to reward is insane, okay? So just keep that in mind. And that's pretty much exactly where we stopped, right at that order block right there. But it's a pretty fair risk to take. You enter here, and then you know that if we break above the key level, break above these highs, then we're probably going to continue up. Okay, so again, a lot of this is about taking the risk, but also it is about looking for additional confluence. And you just go to my other videos for additional confluence. I'm not saying that, oh, just get in because we hit the key level. I'm not saying that. I'm saying that's a major, these key levels act as areas where things can possibly happen. Okay, so these key levels are areas where, oh, pay attention, we might reject, or if we're on top, oh, pay attention, we might bounce. And then you do want to look on higher time frames. If you're day trading, look on the 15-minute time frame and see, okay, what was the last bar off of this level. I also wanted to show you guys, if you stayed this long in the video, if you even care about trading, wanted to show you, hey, how do we draw these key levels? How do we even come up with these key levels? How did you even know something was going to happen here? And the same thing that happened on Tesla on the 19th also happened with Apple. So I said, hey, the key level is 224. If we get above this, guys, get calls. And what happened? Boom, we're above that. It's freaking flying. How do I know that? How do we know that? Well, let's talk about how these key levels are even drawn. Because I know there was someone on TikTok asking me like, hey, what is that indicator with the dotted lines? Come on, man. The only indicator I use is EMAs, volume RSI, Saudi ATRs sometimes. But these dotted lines are drawn in. So if you just go to the left-hand side, horizontal line, put it in, and then you can, most people have just a dashed line. So that's why people get confused when I have the dotted line, but you just go to style and you do dotted. So that's why my lines look dotted. Okay. So what am I looking at on the 2-hour time frame? Well, for one, I'm looking at where did the stock stop to the downside multiple times and then also stop to the upside on the same area. I want to know the area where it moved down and stopped, and then the area where it moved up and stopped. So I want to see if it has both a stop to the downside and a stop to the upside. That's going to be a key level. Okay, so I see a wick reacting off of this area here. So currently it's not yet a key level, but okay, reacting off of this area. Then I zoom in and I see, oh, okay, so we broke below, but then on the move back up, we stopped right there. And then we opened on the next bar right there. So that's kind of interesting. We had a reaction here, and then we had a very cool reaction here where we wicked up. We had opened and closes here, then we wicked up again on that same area. And then on this area, we failed to close above. And we had a wick there, wick here, wick here, wick here. So a lot of touches on that line. And then we stop right there to the penny. And then over here, we stop there as well. So we have multiple hits at that level. Again, a open, a close, and then an open, a wick, reacting to that level. Look at that, reacting to that level. A ton of wicks reacting to that level. And then this was a sell-off below that level. And then we came back up to retest that same level where we had trouble before. So it becomes a support turning into resistance. That's called a support to resistance flip. Okay. And then all of a sudden yesterday we get above. And hey, the last time we were here, we had a huge sell to the downside, no volume, or no, pretty much no volume, just straight selling to the downside. So I said, that tells me that if we actually get above this level, it's going to be a straight sell to the upside to 228, because the last time we were in this area, we had a straight move down. So a lot of the times, based on the ease of movement strategy, if we moved easily down, we can move easily up. And that's exactly what happened. So using these key levels, I'm like, okay, once we get back above this, because this has been resistance, once we get back above this, we could potentially fly. Okay. And again, I just keep it simple, marking these key levels. Mark key levels based on multiple touches. And then you also kind of want to see how was price action acting in that area from this key level to the next key level to the next key level. Look at how price acts in between those key levels, because you'll have areas where, oh, okay, we're going to consolidate here for a long time because we had a lot of price action. Or, oh, okay, we're going to move real quickly through this key level because there hasn't been that much price action here. So keep that in mind looking at key levels. Also showed you guys on the 5-minute time frame, 15-minute time frame ish, how to take some day trades. So hopefully this video helps. See you guys on the next one. It's Mr. Fit to Flourish, and I'm out. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.